Welcome to Navigate Your Wealth. I'm Rebecca Powers. So happy to be here again this week with Karen Stawicki and Samantha Irish, the wonderful ladies who created Compass Financial and also mother and daughter. Good to see you.
Great to be here with you again, Rebecca. Thank you.
Of course, your clients sleep very well at night, and we want to talk about that, of course. But when you watch the news, market volatility, let's talk about the history of the stock market and finances in general.
You know, I love that you started with our clients sleep very well at night, and that is obviously our goal. But most people right now aren't sleeping well. And the reason is because the markets are kind of tumultuous.
Yeah.
We're experiencing the worst start to the stock market since the Great Depression.
Really?
And the second worst start to the stock market ever. We have the first war in Europe in over 70 years, and we've seen the worst bond market since 1982.
Wow.
I mean, think of all of these things compounding right now in this time. And if you were an individual that was excited to retire at the end of 2021, all of a sudden the start to 2022 is a little unsettling.
Very. And you haven't even mentioned the I word, which is inflation. I mean, because you're so positive. So is inflation caused by all the things you mentioned or vice versa?
Well, I think there's some cause and effect certainly in all of those, but government spending certainly is not helping matters. But I want to go back just a little bit because as we've mentioned on previous shows, I have been doing this for over 40 years. And so I want to come back in time because we're talking about what's happening with the market right now. And the question bodes, does history repeat itself? In the 80s and 90s, I always laugh and say it was way more fun to be in the investment business because the market only went up. So all of the 80s, all of the 90s, with the exception of 1987, where we had the largest drop in history in that October Monday, basically the market went up. And people we had double-digit inflation and whatever, all kinds of things going on. But if you remember in 2000, and some of you may not remember this, but the tech bubble burst.
Okay.
So the tech industry in the California, right? They got too big for their britches, and they called it the dot-com bomb. I mean, the market,
I do remember that. Dot-com
NASDAQ
bomb.
Dropped terribly.
Okay.
Well, then it was followed up in 2001. Everybody remembers, never forget, 9/11. So we had another terrible market. In 2002, it was only slightly better. So we had 20 years, basically, of the market going up. And then we had 3 bad years. Now, that's important, not if you're in the accumulation phase, because during that 3 years, everything was on sale.
Gotcha.
But if you retired at the end of 1999 or the start of 2000, those first 3 years completely wrecked your plan, I promise you. Now, in 2003, 2004, 5, and 6, the market started to come back again. So, you know, we have the up, the down, the up, the down. Well, what happened in 2008?
It really went bad.
Housing, right?
That's
the
right,
housing
the real
bubble.
estate
Right,
bubble.
the real estate bubble. So then we had that. March of 2009 was the low. And for the last 16 years, short of January of this year,
It's been good.
The market went up again. So again, I asked that question. If history repeats itself, that period from 2000 to 2010 is nicknamed the lost decade.
Okay.
And do you know why?
No.
The market started at and finished at the same point.
Interesting.
It went down, it went up, it went down, it finished. So they call it the lost decade because if you started with $100,000 in 2000, you ended with $100,000 in
Okay,
2000.
so it was a
So you
wash.
made money. Yeah, but that's not a wash. You lost 10 years. If money is supposed to
Gotcha.
double every, you know, that whole thing, money's supposed to double every 7 years, every 10 years,
Compounding
whatever.
interest.
Exactly.
Okay.
So you lost a lot during that period. And I bring that up because if history repeats itself, are our viewers prepared for the market to potentially have another lost decade? Are you positioned properly so that your assets in 10 years are not where they started in January of this year? Because you can't afford to be in the same place 10 years as you are today.
Well, and so many of the people that come to us, you know, we say, where's your money? Why do you have it there? And so much of it is in the market because they have a short-term memory.
Yeah.
It's not their fault.
It's human nature.
It's human nature. You know what you've recently experienced. And so when you look back over the last 10 years, of course your money was in the market. That's where it should have been.
Right.
But if you have that perspective, and that's where all of your dollars are now, you have to ask yourself, are you exposing yourself to potentially more risk than you may need to be?
And that's why you do the risk analysis.
Absolutely. Every client that we meet with, we sit down and we do this analysis. And here's the interesting thing. We actually had a conversation about this morning, remembering a client. They came in, and in that risk analysis, we like to call it the speed limit. And so we had asked all the appropriate questions to figure out exactly what speed they should be driving, and it came up to be 65. So on a good day, they could go a little faster. If it's, the weather's not so good, they go a little slower. But 65 was about the risk tolerance that they could stomach. Little growth, but not excessive. In looking at their current assets and what they actually had, they were set at 82 miles an hour.
Wow.
Which was way more aggressive than they even realized. And when we looked at what the upside potential for them was versus the downside risk, they could have as much as a 39% upside with a 28% downside.
I think so many people watching right now would agree with me. We had no idea how much risk we were in. You get locked in 20 years ago, you forget about it.
Absolutely. But here's the thing. When we tell a client you have 26% risk, it feels like, okay, that's a number that I can stomach.
Yeah.
Until you put an actual dollar to that number. And so for this client, and we wrote this down because we were mind blown based on what the number was.
Right, $1.5 million was in their qualified funds, and the 28% drop that they could actually have experienced was $420,000. So when I say 28%, you go,
that's not so bad. But when you look at the numbers,
$420,000, that's bad. And we want to talk more about that client because I think that they actually showcase exactly what's happening and what we can do for them. But before we do that, if you have experienced market volatility in your portfolio, if you are worried about the statements that you're getting in, if you are in accumulation period, don't open the statement. Put it away. You're fine. But if you are in distribution, if you are retired, if you count on those dollars, don't panic. Call 855-348-3073. Let us help you analyze exactly what you have, exactly what's going on, and help you find a solution that allows you to sleep at night. Give us a call.
Absolutely. It's no cost, no obligation at all. There's the number again. Of course, the QR code, you can just point your camera to it. It will bring you right to our website. More with how you can retire right as they navigate your wealth. Stay with us.